Please, good morning. I believe you are doing well, please. Okay, good. So a quick one. Now, in regarding petroleum and mining operation, please, this is examination strategy. Okay, I'm telling you how to prepare for the exams on petroleum and mining operation. Please, petroleum and mining operation is coming for 50 marks, as you all know. So therefore, it is very, very crucial. May I know if you can hear me, please? Uh-huh. Yeah, you can hear me. Please, petroleum and mining operation is coming for 50 marks. Hence, it has become very necessary that we all understand and prepare towards it with all kind of seriousness. Okay, let's do all our arsenals at it. Are you okay? To ensure we pass once and for all. Are you okay? Petroleum is not difficult, and the note two is not plenty like you guys think. Mhm. Even though it is 78, majority are past questions. Are you okay? Please, I beg you, go through the theories. Something like the stages, you wouldn't have any issue. Stages of petroleum, okay, upstream, midstream, and downstream. That one, I don't think anyone here doesn't understand. So far as you've joined the class, you should be able to write something about it. Are you okay? It has come on several occasions. Do you get it? Good. Now, understand the world fiscal system as well. Are you okay? Understand the world fiscal system and the features or characteristics of each. The features of the concessionary or the royalty tax, production sharing service contract. Know the features or the characteristics. Are you okay? It's the features that distinguishes it. Okay. If they ask you to give examples or advantages to, you should be able to give, right? Depending on the features. Okay, good. Now, what I'm saying that the question can come in theory or it can come under what? The calculation. Last night it was theory. So this that the possibility of they blending both theory and calculation is very high. Are you okay? Both theory and calculation is very high. They like accent theory, but most of the times too they ask calculations. Are you okay? So please be expecting a blend between the two. Okay, good. Now you have to know the elements of the physical system. Okay, the element. That's the royalty. When you say royalty, what is royalty? When you say interest, initial interest, what does it mean? Additional participating interest, all those things you have to know them. Are you okay? You have to know them. So this is how the question can come. In fact, this is a CIT question. When you say CIT, ICA question. This is a ICA question. Explain the following concept. That's an ICA question. So please take note of that. This is how the question can come. Are you okay? Okay, good. Let's proceed. So they can ask you what is a surface rental, what is stability agreement, carried interest, and all those things. Are you okay? Go. So this the solution or the answer. If they ask you of surface rental, please write this and give the how do you call it? And give the rent that we charge. Give the rent that we charge. Please, this one is in dollars. Uh, so surface rental is the fee you pay per what? Square meter or square kilometer is the fees or the charges on rental per square kilometer. Per square kilometer. Are you okay? The rates charge contractors for such rentals and services shall not exceed the rates charged to other members of the public who receive similar services. Are you okay? So it's in stages. At the first phase, which is the what? The exploration. Are you okay? At the exploration stage, you pay $30 per square kilometer. Are you okay? Now, if you do the the exploration stage, you're just searching for the mineral at this point. At the exploration stage, you are just searching for the mineral. So you pay only $30 per square kilometer. Then you go to first extension, you pay $50 per square kilometer. You go to second extension, you pay $75 per square kilometer. Before you go to the development and production, where you pay $100 per square kilometer. It is 30, 50, 75, and 100. Are you okay? This is at the exploration stage. Exploration stage, you are not sure. You are searching for the petroleum or mining, a mineral. Are you okay? In fact, petroleum, this is under petroleum. You are searching for the petroleum at the exploration stage. So because of that, the rent is not so huge. the rent that you pay is not so huge. You pay only $30 per square kilometer. It is dollars, so you pay $30 per square kilometer. Then you go to first extension, okay? Then you pay what? $50. You go to second extension. The extension in the sense that you've still not found it and you are still searching for it, okay? So firstly, you pay something small, which is $30. Then if you think there's a prospect, you go and extend your what? Your rent. You go and extend your rent again the next year. Are you okay? Then when you find it and you think there's minerals or there's petroleum in the soil, that is where you go and pay your rent. You now pay the proper rent, which is $100 per square kilometer. Are you okay? So that is that. Then we did stability agreement. So stability agreement, the holder of a mining lease may enter into a stability agreement to ensure that the holder is for a period not exceeding 15 years from the date of agreement be adversely affected by new enactments, other instruments, or the other action made under a new contract. Be adversely affected by consequent changes to the level of payment of custom duties or other duties, level of payment of royalty and taxes, laws. Please, I mean, I made this thing so simple for you, right? But then this is what the standard answer is. Stability agreement is the agreement that the government enters or the petroleum contractors, okay, they enter into with the government to ensure that they freeze the existing fiscal terms, they freeze the existing fiscal terms, financial terms like the royalty rate, tax rate, and others. Are you okay? In order to ensure that they're able to recoup their investment. This is how you answer it. You see, if you understand it, you can put it in so many ways and you still get it correct. Are you okay? You still get it correct. Are you okay? Not necessarily you stating exactly what is in a marking scheme. You too, you have your notes that you're learning. How did the note put it? Are you okay? Or do you want to come in and that what do you have? So in fact, this is a question that's key. And what is carried interest? What is additional carried interest or additional participating interest? You see, you write everything you know about it. Like I keep telling you, write everything you know about it. How many times have I gone through this note with you? Plenty times. Because I want you to pass. I've gone through it with you plenty times. This is how you learn. Be going through the thing. I don't know how difficult this thing should be. Oh, Atame. Okay, good. So all these are, I mean, so the same thing. How petroleum is what? Distributed. How petroleum is distributed. I think we did a question on this, right? How petroleum is distributed. That I gave you a situation whereby the petroleum won from the earth is being shared by two companies, and the government too decided to owe a part of it by additional participating interest and carried interest and additional carried interest, right? Good. But you know that with that, you know, the government will not partake in the exploration stage, right? We only partake in the what development and the production stage. We did that, right? So please, how petroleum is shared? How petroleum is shared? Now, the total minerals mined from this earth, you know, the first thing you do is to deduct the royalty. When you deduct royalty of 5%, the rest is the net that is to be shared to the what? To the entities that have come together, okay? Including the government. Please go and watch the recorded video on that in case you couldn't join. Then you have unitization. There hasn't been any question on unitization yet. They've never asked what is unitization, what are the importance of unitization. That's why I said take it serious. They can ask at your time types of unitization they've not asked before, reasons of that, redetermination, and all those things. Please take the note serious. Then we come to the calculation side. Okay, we have acquisition cost. Acquisition cost. Acquisition cost refers to expenses incurred in obtaining the right to explore, develop. I mean, the right that you buy, the licenses you buy, the license you buy, are you okay? At the initial stages of your production. That's what we call it acquisition cost. When you started the petroleum operation, the asset you buy at the initial stages. Sometimes you have to pay for license. Are you okay? All these, no, They are incurred at the initial stage. You have to get a license. You have to pay for the license. Are you okay? All these are incurred at the initial stages. Are you okay? And therefore, we call it what? Acquisition cost, license fees, and all those things. True or false? True. Exploration cost. Cost to do exploration. How do you do exploration? So all costs involved in exploration. Are you okay? That is cost in doing research on the site. Do you get it? Doing research on the site. So exploration costs include charges related to collecting and analyzing geological and seismic data. Are you okay? Charges involved in collecting and analyzing data. Are you okay? These costs may be intangible or tangible. Are you okay? Tangible costs, please, I beg you. All costs of exploration should be capitalized, should be treated as a capital asset because, please, you all know, when we started exploration, by that time, we have not started commercial production. We've not started commercial production yet. So any cost involved at the exploration stage, should be capitalized. Any cost involved at the exploration stage, treat it as a capital asset. Treat it as for capital allowance purposes. Are you okay? Development stage too the same. Any expenses incurred at the development stage, by that time we have not started commercial production. We have not started commercial production. So any cost. Okay, so he said development costs involving preparing developed reserves for production, such as construction or improvement of infrastructure like roads, pumps, like pipelines, and tanks. Both methods allow capitalization of all development costs. You have to capitalize all development costs. Once they commence production, once they commence production, you now have to start expensing any assets, except capital assets. When you start commercial production, it's only capital asset that you capitalize. If any expense is incurred, whether development or production, once they have started commercial production, you have to expense it. Are you okay? Unless maybe it is something in relation to capitalization. Okay, so good. So production cost, they said production cost should be what? Encompasses expenses related to extracting oil and gas. Production costs are considered part of the periodic operating expenses. They are part of the operating expenses and are charged directly into the income statement. Are you okay? Amortization and all those things, they are disallowed and you use capital allowance. Allowable deductions. Ladies and gentlemen, these are allowable deductions. Allowable deductions. Know them. Sometimes the question can say, state five allowable deductions under petroleum operation. State five allowable deduction. It's not difficult to, but sometimes it can ask students to. Then we have treatment of financial cost. Financial cost and financial gain should not be on the face of the statement of financial performance. When you're preparing petroleum mining operation, you don't have to have financial cost and financial gain as part of the statement of financial performance. Okay? Rather, you treat it separately, whereby any financial cost should be subtracted from a financial gain. Any financial cost should be subtracted from a financial gain. If you subtract and you get, and if you realize that the financial cost is more than the financial gain, so when you subtract, let's say you have financial gain, of 10 cedis, you have financial cost of 50 cedis. When you subtract this, you realize that you still have excess financial cost. Ladies and gentlemen, this excess financial cost should be carried forward to the next year. This excess financial cost should be carried forward to the next year. Are you okay? So that's how it works. Thank you very much. So remember, financial cost and financial gain should never be on the statement of financial performance. When you're computing the chargeable income, make sure it does not include financial cost and financial gain. Are you okay? So this is one way calculation question can come. Please open your eyes. Those dozing off. Please open your eyes. The devil is a liar. Please, we are done with the theory under petroleum, okay? This is one way a calculation question can come. This is one way a calculation question can come, whereby they will say the following is relevant to AB Limited, operating upstream sector. Good. So they'll give you revenue, they'll give you cost, and they'll give you the net profits. When they give you the net profit, it means you have to go through this footnote and add back where necessary. You have to go through these footnotes and add back. Add back where necessary. Example, see, the revenue above includes financial gain. You know that it's not supposed to contain financial gain. So you say less financial gain they added. So you say less financial gain. Here they said the financial cost is this was added to the cost. So if financial cost of this was added, there is a less or add back financial cost. You have to reverse the financial cost because they less it, so you have to reverse it. This is one way it can come. It can come like the way business income comes. Okay, whereby they'll give the net profit and you have to adjust it. It can come in this way. When it comes in this way, all what you have to do is to go through the how do you call it? The additional information and say add back, reverse, do this. That's what you do. Are you okay? Okay, thank you very much. Yeah, yeah. That's how one way it can come. Are you okay? So you have to know the principles. You know that at least research and development is not under petroleum mining operation. Under petroleum mining operation, we don't allow research and development. You should know it. You understand it? You should know that, oh, under petroleum mining operation, we do not allow research and development. So you see, add back research and development. That's how you go about it. Are you okay? It's not difficult, nothing difficult unless you don't understand. This is one way it can come. So here they'll give you a financial statement that they have prepared from a petroleum company that has already started production. A company that has already started production. So they'll give you the financial statement. And you have to be adding back, like the way you have been doing. Are you okay? Good. Petroleum fund management. Uh, petroleum fund management. Okay, restrictions on the petroleum fund. It cannot be used as a collateral. It cannot be used to extend credit to government or a private company. So restrictions on the petroleum holding fund. Okay. Receipt into the petroleum holding fund. Where do the money come from? Any revenue be from petroleum hits the petroleum holding fund first. Example, royalties, revenue from participation interest, such as carried interest, initial interest, corporate tax, dividend, any revenue from petroleum hits the petroleum holding fund. Okay. So please be watchful of this theory too. We are done. Nothing difficult. We didn't do anything. We didn't do anything. You are you okay? Then please, I beg you. So this thing, if you go to examination, I tell you that it can come. Take it serious. Are you okay? So we have the prospecting. So this one to mineral to the same thing. And we have the mining rights and mining license. Okay, we have the recognizance license, prospecting license, mining lease. Okay, this one allows you to search for petroleum minerals without digging, without excavation. But this one it allows you to search for mineral that it allows digging, it allows excavation. Okay, and this one is the lease, whereby they will give you 30 years lease for you to do what as mine for what minerals. Is that also that is so recognize. So please that. Then you have the mining support services. We have their tax rates. We have tax incentives. We have income from this. Go through them, please. Approve rehabilitation fund and all those things. Are you okay? Please go through them. Now, you've solved all these questions, right? So the question can come in this format, whereby they'll give you the margin. You see, is this not a similar thing that came? They'll give you a margin. That's the net profit. The margin is the same as the net profit. Don't be confused. Go through the additional information. Anything you say you want them to reverse, say reverse this. That is you add back, add back, add back, add back, add back. If there's any revenue they were not supposed to pay that as revenue, you less it. No, you are done. Like this, you are done. Take your net profit, add back, add back, add back. Take your net profit in margin, add back, add back, add back, add back, whatever. Deduct when necessary. That's all. The surface renter and all those. Okay. So another one. Kaka. They give you the what? The profit. Are you okay? Then go to additional information. Anything you want them to reverse, you reverse it. I think we've done that. In fact, we've done it. Class, I would like to find out something. Sometimes they can ask to calculate the royalty. Please, have you done this? Crystal Mining Limited. Class, please, have you done Crystal Mining Limited? Have I solved it with you?
Yes,
Yes.
please. Yes.
Okay, very well. Okay, good. Good. Simple. So the thing like I said, I'm saying can get dim. But we've not done this right. Alpha. I gave you recorded video to go and watch. Is that not so? Okay, good. Now, this is another way the question can come. Are you okay? This is another way the question can come. In this instance, they will not give you the normal this one. Okay. Here, see this question. Say Alpha Limited is a company operating in the upstream sector and commenced production in 2020. The accountant who is new in the industry provided the following extract for the year. Listen, listen. He says that what? The accountant who is new in the industry provided you the following extracts for 2020 year of assessment with the basis for January to December. Wait a minute. Alpha Limited is a company operating in the upstream petroleum sector and commenced production in 2020. Commenced production in 2020. But then they have given you everything. They give you the net profit margin. So you just take the net profit margin. You just take the net profit margin. Then you be adding back the rest. Add back, add back, add back. Are you okay? Add back, add back, add back. Let's go quickly. Let's do this quickly. Even though I want to explain certain things to you. Are you okay? Because this is the only way the question can come. It's either it come in the form of the first part or it comes in this. There are only two ways the question can come. In this format and the Carnival format. So, I mean this format, like Crystal Mining Limited. You see the format of Crystal Mining Limited, whereby they will give you the summary of the financial statements like you are seeing here, summary of the financial statements, and they'll give you additional information. It's one way. This is the one way. And this is another way. That they'll give you the financial statement proper. Are you okay? They give you the financial statement proper and tell you when they started commercial production. They said they started commercial production in what? 2020. So before 2020, any expenditure yeah, that was incurred, you have to capitalize it. Before 2020, any expenditure yeah, that was incurred, you have to capitalize it. No wahala, anything. Okay, good. So please pay attention to when they began commercial production. Okay, the time that they began commercial production, any expenditure, yeah, you have to what? Capitalize. Are you okay? Capitalize expenditure and capitalize asset as well. Okay. Thank you very much for the resource sheet. Okay, good. Let's go. So we have Alpha Limited, right? Alpha Limited. Is that also? Okay, let's go. So quickly, this one will not waste time. Requirements. It says that what? Compute the tax payable for Alpha Limited. I want to be explaining certain things to you, right? Some of you have not watched the recorded video. Me, I know. They will not watch. But because me, I want you to pass. So me, I'll take you through again. Because petroleum mining operation, apart from the theory, and these are the only questions. Anybody who doesn't get 20 over 20 under petroleum, I don't know. Compute the tax payable. Okay. So financial statements. Did they carry any zeros? No zeros. Let me carry zeros. Make sure. I'm carrying 3 zeros. I've carried 3 zeros. So now you go and take the transactions one after the other. Is that also? Okay, let's go. So the first one, we have gross revenue. We have processing, cost of processing. Good. Other cost. So let's go. We have license cost. License cost. Who can tell me how you treat the license cost? Is it supposed to be an expenditure? The answer is no. License cost is not supposed to be an expenditure. Are you okay? License cost. It is a cost that you incur when you begin production. Are you okay? It's in fact, it is one of the first costs you incur. Huh? The license cost. Okay, the license. You paying for license. License, they will give you the license before you can even operate. Are you okay? So this one, no, it is an pre-production cost. License cost is a what? It's a pre-production cost. License cost. In order for you to get a license to even operate, it's one of the first things you pay, even before you discover the petroleum or whatever. Are you okay? So license cost is a pre-production cost. Are you okay? So here is a pre-production cost. In fact, let me open another. So here we capital allowance. As a capital allowance, no, it captures all expenses before production, all expenses that you incur before production. So here, no, reverse the license cost. It's supposed to be part of the pre-production cost. So license cost, 1,000. Just 1,000 will come here, license cost. I'm done. Please, are you getting why I'm reversing it? It's a pre-production. This one, license cost, you incur it. When you idea, it's not an expenditure that you incur after production. Huh? It's not an expenditure you incur after production. It is something you have already incurred. Look at second one. Exploration cost. The cost to explore. The cost you incur during the exploration. This is a pre-production. You have to incur this cost before you start a commercial production. Are you okay? It is, you do exploration first, then you go to development before you go to production. So all these, no, and we say that you start expensing at the production stage. Any exploration cost and development cost, no, should be what? Capitalized. So therefore, you have to reverse this. Add back exploration cost. Add back exploration cost of 40,000. You're supposed to go to here. Asa, we now go to development cost of 60,000. That one to reverse it. Huh? This is these are all before production cost. So development cost of 60,000. All these, no, you were supposed to treat it as part of the capital allowance because in money and petroleum production, the capital allowance, no, it involves any expenditure before production. Before production, any expenditure before production. We start production in 2020, and because the accountant is new in the industry, he has included all costs, including the pre-production cost. So therefore, we are reversing them. As a chartered accountant, you have to know that these ones, no, they're not supposed to be here. Are you okay? They're not supposed to be here. They're all pre-production costs. So therefore, reverse it. So we are reversing it. Now we are adding back so that we what? We send them to capital allowance. That's all what you are doing, nothing difficult. Can you see that? So Asan, so they'll give you a question whereby you have to calculate your own capital allowance, or they'll give you the normal one you have been doing. Are you okay? Okay, thank you. So we go on. Next one, development cost is 60,000. We have reversed it. And we have added it to the capital allowance instead. 60,000. Okay, let's continue. Next one is what? Production cost of 80,000. Production cost of 80,000. This one, dear, it is an expense. So don't reverse it. This one is what? An expense. So do not what? Reverse it. Production cost of 80,000. This one, dear, it is an allowable expense. So do not reverse it. Okay, good. We go on to the next one. Research and development. Like I said, what do they do at the exploration stage? Who can tell me? What do they do at the exploration stage? This exploration stage, no, what do they do? Don't they do research? They do research there. So please, in petroleum and mining production, we don't tolerate research cost. We don't tolerate something called research and development cost, Abi. Because you cannot do research at the exploration stage. Then when you finish, you come and say that you are deducting another research and development cost. What are you deducting again? Because at the exploration stage, you have something we call exploration, which is mainly for research. Then you have another thing we call development, only for development. So these things, no, the research and development, this research and development, we expect you to incur that cost at the exploration and the development stage, which you are already capitalizing. So you don't turn around and say that there's another research and development cost. So in petroleum mining operation, we do not correlate research and development cost. To have to reverse research and development cost. We do not correlate it. Okay? So for reverse it. Don't capitalize it too. It's a disallowed expense. It's a disallowed expense. You don't capitalize it. It's a disallowed expense. So we are done with this one too. You don't add it to capital allowance. It's a disallowed. So research and development in petroleum production is a disallowed expenditure. But then in business income, that one is an allowable expenditure. It makes sense, right? Perfect. Good. So now let's go. Next one is what? A purchase of land. Purchase of land. Please, purchase of land, no, you don't have to expense it. It is a capital asset. So reverse this. Purchase of land. It's a capital asset. The accountant will bump. How can you expense land? But this purchase of land too cannot go to capital allowance. In fact, it's supposed to come to capital allowance. But because you and I know that we do not depreciate land, we do not calculate capital allowance on land. That is why we will not put it under capital allowance. So purchase of land, we will not put it under capital allowance because even though it's a fixed asset, even though it is a non-current asset, but we will not depreciate it because it is not a depreciable asset. So this one, I'm done. You just reverse it. You reverse, but you not bring it to capital allowance because it's not a depreciable asset. Thank you. Now we go to the next one. Staff cost prior to production. What does it mean? What do you mean of the prior to production means? You raise your hand. When you say prior to production, please, what does it mean? Prior to production,
Before actual production started.
before actual production started. Yes, brofo. Prior to production, before production what? Started. Prior to production, before production what? Started. Are you okay? But then you know that before production started, please turn off your videos, all of you. So you have the following persons. I've turned off nah, nah, I'll stop your video for you. Good. Perfect. I think everybody's video is off now. Good. God bless you for joining, eh? It's a good thing you are doing. Before production started, are you okay? Like we said, if you understand the principles, you should be able to do any question that comes your way. Before production started, you do not expense it, but they have treated it as an expense. Before production started, no, the staff cost you paid, you are supposed to capitalize it. You are supposed to capitalize it before production started. Any cost you incur, you capitalize it. So staff cost prior to production, the cost of staff before production, you have to capitalize it. So first of all, reverse it. Okay. So reverse it. So this amount, no, staff cost before production. Okay, we go on. Staff cost during production. Staff cost during production. During production is an allowable expense. During production, you have to expense it. So it's an allowable expense. So you don't do anything about it. You do not reverse it. Because them say during production, the staff cost you paid. So that one you have to expense it. So it's the right thing they have done. Can you see that? Good. Go to the next one. They said what? Seismic data. Seismic data exploration. So this is at the exploration stage. When you hear the word seismic, please, seismic. When you hear the word seismic, uh, in petroleum, when you hear the word seismic, it relates to what? Exploration. It relates to searching. It is the searching for minerals. So the data they got in relation to the search for mineral during production, sorry, seismic data, exploration, exploration, exploration. So seismic data. You have to reverse it. 110,110. This amount, no. If you reverse it, you have to add it to your capital allowance schedule. You have to add it to your capital allowance schedule, right? So seismic. Next one. Cost incurred in hire of geologist. Cost incurred in hiring of geologist from a rival company. From a rival company at development. Okay, during the development, we hired a geologist. Now, geologist is involved in the search for minerals or petroleum. Geologist, they study the environment to identify where we can find the petroleum. Are you okay? So they are hired during the searching stage or the development stage. Some say at development they added it. So it means that this one too, it occurred before production. It occurred before what? Production. So you see hire of geologist. It occurred before production. How much? 15,000. Reverse it. Okay. So you reverse it and you add it to capital allowance. Add it to your capital allowance. Okay, good. So let's continue. Next one. Proceeds from sale of assets before production. Please, before production, we sold an asset. Before production, we sold an asset in petroleum production. In petroleum production, pay attention. In petroleum production, no, wait. Before production, please pay attention. Before production, there's nothing called revenue. Before production, we've not started production, we've not started selling. So there's nothing called revenue. Okay. It's either you are buying an asset, huh? Or the asset you have bought is no good, so you sell it. You get it? Before production, you have not started commercial production. So you don't have anything called total revenue. No, 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 no. Before production, maybe you are doing research. You can go and buy an asset to do the research for the petroleum. If that asset is not good, what do? You sell it off. True of us, true. So therefore, if in the course of the exploration and the development stage, they decided to sell an asset, it means already they had the asset and they have sold it off. So what do? If you make any revenue during the pre-production stage, if you make any revenue during the pre-production stage, that revenue should be deducted from your capital allowance schedule. If you make any revenue, that revenue should be deducted from your capital allowance schedule. If you make any expense, it should be added to the capital allowance schedule. If you make revenue, it should be deducted. It is fair, right? Because you have not started production. So therefore, if you make any revenue, you sell anything at the pre-production stage, you have to less the revenue from the capital asset pool. Are you okay? From the pool. Do you get it? The capital allowance pool or schedule. You have to less the what? The revenue from the sale, no, from the pool. So for true, it makes sense. It makes sense. Do you get it? So they said proceeds from sale of revenue. So he added the proceeds from sale of revenue to this, to the after production. But then we incur this revenue before production. So therefore you less it. Proceeds from sale assets before production. Before production, you don't have to add the proceed. You don't have to add the revenue to it. To less it because they added it. So you have to less it. I'm lessing it. It's a principle, okay? They added it to the financial statement. So I'm what? I'm lessing it. It is part of this. Oh, so I'm lessing it. So if you are lessing it, it's in bracket. So I'm not putting it in bracket because it is bracket here. This process 9,000. I'm lessing it. That's why I put it in bracket. T free. I'm lessing it. Okay. Uh-huh. I'm not putting it in bracket because it's a bracket here. I'm lessing it. I'm lessing it because if it is added, then you have to less it. Okay, thank you. Then after you less it here, you have to come and what? Come and less it from the revenue or the capital allowance pool. Okay, so proceeds from asset sale, less it. Subtract it from the. If it is expense, I'll be adding it to the capital allowance schedule. If it's a revenue before production, I have to less it because it is going to reduce the total asset you bought during the pre-production stage. It's going to reduce the total asset you bought during the pre-production stage. So please, I'm giving any more God. If you dispose of any asset at the work in progress stage, work in progress at the pre-production stage, less it. Don't go add it. No, 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 no. Are you okay? Okay, thank you. It makes sense. It makes sense. Next one. Penalty by the Petroleum Commission. We pay the penalty. Penalty should be disallowed. It's a disallowed expense. So penalty. How much? 670. Please, this penalty, don't add it to the capital allowance schedule. Don't add the penalty to the capital allowance schedule. Why? Because it's a disallowed expense. Nobody asks you to go and pay penalty. So that one is not a capital asset. It's not a pre-production expense. So this one is a disallowed expense. Next one, fine. Fine to be the same thing. Disallowed. Add it back. Reverse it. It's not a pre-production expense. Reverse it because fine is no good. Nobody asked you to go and pay fine. If you did the right thing, you wouldn't have paid fine. So I've reversed it. Thank you. Now, hedged gains. Hedged gains is a financial gain. Hedged gain is a financial gain. And if you remember very well, I told you that if you are preparing petroleum mining operation, the financial statement or the in getting a chargeable income, it should never contain financial cost and financial gain. It should never contain financial cost and financial gain. And for exams purposes, if they don't want to tell you it is financial cost, they will intentionally say swap. They will intentionally say swap. They can say swap gain or swap loss. It's the same as financial cost or financial gain. They can say hedge gain or hedged loss. Are you okay? So please do the same as financial cost and financial gain. Hedge gain is the same as financial cost and financial gain. So therefore, hedge gain, it does not have to contain hedge gain. So if there's a hedge gain, you have to revert the hedge gain. Hedged gain of 2 million. It's a credit. International bracket mono. So you say less hedge gain. I'm lessing it. Bracket 200. I've less it. Because gain, they added the gain to the financial statement. So therefore, if you have to do this one, you have to less it. So I'm subtracting. Are you okay? Hedge gain. Do you know why it's in bracket here? Because it's a credit. It's a revenue. Revenue is a credit. Right? Revenue is a credit. It doesn't mean it is a negative number. That be. It's a revenue. Right? So hedge gain, no, you have to less it. I've less 200. I've less 200. Because again, you know that when you are doing petroleum mining, it shouldn't contain revenue and expense. So it shouldn't contain financial cost and financial gain. Rather, it should be treated against themselves. You are supposed to go to a different place and go and subtract the financial cost from the financial gain. Are you okay? So if it is a gain, reverse it. If it is a loss to reverse it in that order. Are you okay? Me, I respect you. Me, I respect principles. Next one. Christmas tree. Ladies and gentlemen. So I had so many calls relating to the Christmas tree. Please, this one is not the Christmas tree, you know. This is not the Christmas tree, you know. Let me show you a Christmas tree so that it will never. Let me show you a Christmas tree so that it will always be ringing a bell anytime you see it. In petroleum production, if you see Christmas tree in oil and gas, Christmas tree in oil and gas industry, image, show image. Please, Christmas tree is an asset. So this is a Christmas tree. Haven't you seen something like this before? Something like this. That they drive. They, when Akufo-Addo, I remember very well, when Akufo-Addo went to one of the oil stations to go and commission it. I remember seeing that he was driving it, a big one. Christmas tree, that's what they drive to direct the flow, okay, of the oil or petroleum from the soil. You get it? They drive it. Also, you drive it. They will be, oh my king, that's a Christmas tree. This thing's an asset. It's an asset, oh, it's an asset. Non-current asset. You get it? This is an asset. Christmas tree. It has so many wheels. Then they'll be driving. I believe you understand Christmas tree. Any Christmas tree, this one. This is a Christmas tree. So please, those of you who call me, say Steven. So the Christmas tree, no, was it on vacation? Or please, no. A near vacation Christmas. Any and say Steven, how will you know that Christmas tree is an asset? Because it's a Christmas. Since when did Christmas become an asset? Hey, no, this is not Christmas tree. Are you okay? This is the Christmas tree I'm talking about. Okay, thank you very much. This asset, this one that they drive. When you go to the petroleum site, you see it. Okay, this one, they drive it. You see, if you want the fuel to flow, you chin chin it. If you don't want it to flow, you don't stir it. Right? You stir it. Then the petroleum is flowing. Christmas tree, Christmas tree, Christmas tree. Christmas tree, Christmas tree, not this Christmas tree. Okay, thank you. So that's a Christmas tree. Now I know you'll never forget again. So when somebody calls me, I'll tell you, go online, search for it so that you have a clear picture in your mind. You have a clear picture in your mind so that it will not confuse you. This is the Christmas tree. Once you are talking about petroleum mining operation, this is the Christmas tree you're talking about. Are you okay? So this one should be what? So see, Christmas tree. It's an asset. You don't have to expense it. So Christmas tree, 30 million. So you are reversing it. Add back. I'm adding back. Can you see that? I'm adding back. Then when I come here, I'll add it to capital allowance. Okay, good. We go to the next one. Bonus payment to government. Bonus payment to government. Please, anytime they discover petroleum, anytime they discover petroleum in large quantity, do you know what they do? They share bonus. Okay. When they discover petroleum in large quantity, they share bonus. Bonus. Even before they start production, when they see the petroleum, hey, they'll be sharing bonus. Hey, you understand it? So we capitalize bonus. Bonus should be treated as an asset. You capitalize it because it happens before production. Because the bonus, no, it happens before what? Production. The bonus occurs before production. Okay? Good. So when you read the notes very well, you realize that it's even a note. It's even a note that we capitalize bonus. I don't want to go there. So bonus payment, reverse it. 340. I'm adding back. I'm adding back. Okay, what do you have to do? You have to Capitalize the bonus. Okay, good. We go to the next one. Sales proceeds from sale of assets after production. Proceeds from sale of assets after production. So after production, they dispose of the assets. See, where then after production, not before production. No. After production. Now let me ask you. This is petroleum operation, right? In petroleum operation, when you dispose of an asset, how do you treat it? How do you treat it? And this is how you treat it. In petroleum production, you have to go and add the proceeds you receive, no, to the income in the statement of financial performance as other income. Are you okay? If you dispose of an asset, the income you receive, no, go and add this the statement of financial performance as other income. You don't subtract it from the pool. Don't subtract it from the pool. So when you receive the money, just go and add it to other income in the statement of financial performance. Full stop here. That's how you treat it. So that's what they did. Okay, they've added it. Can you see that? It's in bracket, it's a credit. So this one is good. You don't reverse it. You don't reverse it. But if it is money production, we would have reversed it. Because in money production, when you dispose of an asset, the revenue you receive, no, go and less it from the pool. Unless there's a gain before you send again to the statement of financial performance. Okay, good. Let's continue. Payment for infraction. Payment of infraction. Do you know infraction? Infraction is more or less like a penalty. Payment for penalty or fine, something like that. Infraction. It means you didn't do something wrong, right? Payment for infraction of regulatory requirements. So nobody has to go and pay infraction. So this one, general will reverse it. They will not allow you to treat it as an expense. Infraction. They will not allow you to treat it as an expense, so you reverse it. But it's not a capital asset either. It's not a capital asset either. God. Now, next one, marketing cost. Marketing cost is an operational expense. Yes, so that one is an allowable expense. You have to do marketing before you can sell. So it's an allowable expense. Next one, letter of credit cost in connection with purchase of oil. Now you are going to buy oil and you went for a letter of credit paying 80,000. You paid 80,000 in order for you to what? Purchase oil. Please, they will disallow it. Do you know why? Because this one is not an expense, that is a requirement. Is it by fault that you have to buy the oil using letter of credit? That you have to go and incur a cost of 80,000? You understand it? Others are buying oil without incurring this letter of credit. Others are buying oil without paying any letter of credit. You said you have to go for letter of credit, and therefore it's no. This one is not related. It's not wholly, exclusively, and necessary. This one is not necessary. Yes, you have incurred it, but it's not necessary. If you want to purchase oil, you don't have to go for letter of credit first. Are you okay? So therefore, because if they allow you that, okay, we have agreed, next time if they come, you see that you see letter of credit 200,000 because you allowed them the first time. So this one has to tell them that, hey, this expenditure is not wholly, exclusively, and necessarily incurred. It's not necessary. So letter of credit, you have to reverse letter of credit. How much? 80,000. No, 80. I'll not add it to capital allowance because it has nothing to do with capital allowance. So I'm done with this. The last one, hedged loss. Hedged loss. So hedged loss, you have to add back. But like I said, financial loss and financial gain is not included. So hedge loss, which is a financial loss. Reverse it, add it. So they treated it as expense. You have to add it. Are you okay? Then we are done. The last one will be, we have something here. Yes, we have something here. That says, it says production in barrels is 120 million. Finance lease, principal repayment is 50 million, and finance cost is this. Okay, good. Now, listen. They said that what the company has a finance lease. Are you okay? And the finance lease, no, the principal is 50 million and the finance cost is 120 million. And this is over 6 years. Are you okay? So, finance lease, when you have a finance lease is you leasing an asset, but then it's more or less like the asset belongs to you. That's what it means. So, finance lease, no, it's like the asset belongs to you. Are you okay? Because you'll be using majority of the assets. The useful life of the asset, you'll be using majority of the useful life of the asset. That is one. Two, in finance lease, no, you bear the risk and reward. Are you okay? In finance lease, no. In fact, it's like the asset belongs to you. Are you okay? So therefore, you have to take care of, you have to charge capital allowance on the principal part of the finance lease, and you have to treat the finance cost as an expense. Are you okay? So you have to treat the finance cost as an expense, and you have to treat the principal as a capital allowance issue. Are you okay? So let's go. So they said finance lease, you are paying finance cost. So working through. So we have finance cost. Finance cost is 1200, and this 1200, no, you are paying it over 6 years. So therefore, finance cost is every year. How much are you paying? 1200. How much? Every year, how much are you paying? Divided by six. So every year you are paying 200 cedis. So finance cost. So it's an expense. It's an expense. Okay. Then the principal of the finance cost. The principal. So please, the principal part of the finance leads to you are supposed to complete capital allowance on it. Are you okay? So principal, 15,000. I've subtracted three zeros from it times 0.2. That's the capital allowance. How much, please? So 1500 times 0.2. That's the capital allowance. Capital allowance is how do you call it? Capital allowance is how much? 20%. You know that's right. 20%. So 20% on the finance lease principal. So finance lease, no, the principal, you charge capital allowance on it, and the finance lease, no, that is the finance cost, the interest. You treat it as an expense. Are you okay? So this one is for 6 years. So divide it by six. That will give you the principal, the capital allowance for 1 year. I divided by six, but let me present it so that when you're ready, you understand. Okay. So that's 20%. I'm calculating capital allowance. Capital allowance in petroleum mining operation is 20%, right? So 3,000. This is the capital allowance for the entire 6 years, right? This is the capital allowance for the entire 6 years. So therefore, capital allowance. Okay, good. Then have capital allowance. This will be the chargeable income. This will be the chargeable income. So let's quickly add all this. Add all this, and capital allowance.
Hello, sir. What of royalty?
Yes. So the royalty, I've decided to ignore the royalty. Okay. I decided to ignore the royalty because the question didn't make any reference to that. The question didn't make any reference to royalty. That's why I decided to ignore royalty. I'm assuming that royalty has been charged as part of the cost of processing. Because the question could have given me a clue that, for instance, they will put something like royalty has not been paid, or the my petroleum company has not paid any tax to the government for the entire year. They could have given me a clue. Please do you get it? They could have given me a clue for me to know that indeed royalty has not been paid. But here they were silent. Nothing. So me too, I'm assuming that royalty has already been charged. That's me to my assumption. That royalty has already been what? Charged. Because I see cost of processing, which they are deducting. Does it include royalty or not? So I'm assuming that royalty has been charged. But then you can also assume that royalty has not been charged. So you go ahead and charge 5% on the 900,000 and you write royalty. So when you finish writing that royalty, you come and make an assumption, write an assumption that I'm assuming, if I let me also make an assumption. I'm assuming royalty has been charged on the gross revenue already. I'm assuming that royalty is part of the cost of processing. That's what I'm assuming. That is me. Are you okay? Uh-huh. So you two, what are you saying? Because this is other cost. This is the cost that they think is problematic. Are you okay? What are you also assuming? Are you assuming that royalty has not been charged? If you are assuming royalty has not been charged, then calculate royalty of 5% on the 900,000. Then less it. You two are correct. When you finish, come and write that I'm assuming royalty has not already been charged. So I calculated royalty of 5% on the 900,000 and I got this. So you two, your answer will be what? Correct. Madam, please, are you okay? Is your question well answered? Okay,
Yes,
thank
please.
you.
Thank you.
You're welcome. So because they didn't make any reference that the government has not paid any tax, I'm assuming that the government has already paid the royalty on them. Okay, good. Let me proceed. So let's quickly find them. Please, let's find them for me. Total. Find a total capital allowance for me, please. Total. 5, 41,000 plus 60,000 plus 45,950 plus 1,500. So if you don't have calculator, so total. So last, I think the recorded video, I deducted royalty, right? Here I didn't deduct royalty. I mean, the last time I was doing it, I deducted royalty. But this time around, I decided not to deduct it. So it depends on you. What you also want to do, you do it, okay? And I see my Kingston, they didn't deduct royalty. But in some books that I've seen, they deducted royalty. You understand? It's open. So anything you do, they are there. Divided by 5 or times 20%. So the capital allowance. The capital allowance. So 5, 280. So the 35%. 35% of everything. Add everything times 35%. So when I added everything, I got 100,000. That is me. Go and do the right thing. When I added everything, in fact, I got 200,000. No, 2 million. Okay. Then times 35%. 2 million times 35%. You get 700,000 to be the tax. That's all. That's all. So please pay attention. You see, what is my focus here? My focus is that I want to tell you that any expenditure that is incurred before commercial production should be capitalized. That's what my focus is. Any revenue they got before commercial production, you have to less it from the pool or the capital allowance schedule. So, apart from that, if they give you any other question which is not in this format, that one you are good to go. Is the normal business income structure. Are you okay? Good. So, what am I talking about? Any question on this? No question. What am I talking about? I'm talking about this. 1 second, please. I'm talking about this. I didn't see my screen. See this canoe. The reason why I wanted you to do canoe. See canoe. You see canoe. See canoe. Canoe Mine Resource Limited was incorporated on 1st January 2017 to mine gold and diamonds at Prestea in the western region of Ghana. Various reconnaissance and prospecting activities took place from 2017 to 2019. Actual production started on 1st January 2020. Actual production started on 1st January 2020. The following were cost and revenue relative to reconnaissance and prospecting activities. Okay, from 2017 to 2019. They said actual production started in 2020. Actual production started in 2020. And they have given you the cost that was incurred from 2017 to 2019. Okay, when we're doing the prospecting, reconnaissance, looking for the place to mine. Okay, then finally in 2020, they decided to go into full or commercial production. So after 2020, that's when you can expense the any expenditure. But before 2020, any expenditure they have to capitalize. So look at this. In 2017, you have to capitalize everything. 2018, capitalize everything. 2019, capitalize everything, except the ones you are not supposed to. Disallowed expenses, except disallowed expenses. Are you okay? If the thing is disallowed, you don't have to include it. Are you okay? So let's go through. So analysis. So we are doing a solution. I just want to take you through. Okay. I know the recorded video. Some of you will not watch. But for me to do my work and do it very well, let me take you through. So when it comes, I know I taught it. Can a woman, right? Good. So what you are coming to do is that you are coming to find total assets before production. Okay. In fact, total asset that you have to calculate capital allowance on. Total assets. You have to know our total assets. So total capital allowance activities. Are you okay? Or total work in progress activities. Total asset before production. Before production, no, total asset is not only physical assets. Total asset is not only physical assets. Huh? So in the pool, no, you have all transactions that occurred before commercial production. So this is what you do. You add, let's go, please. I'm coming to do a skeleton here, but then I'll show you the real solution, right? So what you do is that you have to find the pre-production. Let's go. You have analyzing historical exploration data. So in 2017, so 2017. First one, analyzing historical exploration data. Analyzing historical exploration data. I cannot be writing all this plenty thing. Oh. You should go and do it. So basically, what you do is that, in fact, I have a solution there. Wait 1 second. Because of the time, I cannot re-record this again. If not, we'll close 20 o'clock. The thing was mute. Okay, no wala. I didn't ask them not to join. Okay, good. So Jerry understands. Are you okay? When you go to the when did I mute it? Alright. When you go to the location where you're going to do the mine, they understand that at least you have to pour small libation. Do you get it? Yeah, Jerry understands. They have to pour small libation. For that, they understand. You get it? So they will allow you, okay, to pay this protocol to chiefs. Do you get it? They will allow you for the first year paying buying schnapp, okay, for the chiefs is allowable. For the first year, this expenditure is allowable. Buying cheese for the chiefs. You definitely buy schnapp for them. You go and greet them. You go there. You go and introduce yourself. It is a custom. Ghanaian custom. When you're going to mine in a company, in a town, you first of all have to go and meet the chiefs and, introduce yourself. When you go there, you cannot go with an empty hand. Are you okay? So for that, they will allow you to what? To pay or pay something small to the chiefs. Are you okay? That is 10,000. That is an allowable expenditure. Are you okay? So you capitalize it because it's a pre-production. The next one, topography of a study, capitalize. Biological and geochemical studies. All these are pre-production expenditure. Please don't just answer, don't just think of how to score the answer, but rather take note of the transactions. Because when you go to the exams and you don't bring this exact question, and you go and see something like geological and geochemical studies, you have to know that this is a pre-production expenditure. You have to know. Like the question we just of Alpha Limited, and you see something like geological and geochemical studies, you have to know that it's a pre-production expenditure. So while solving this question, you have to be taking note of the transactions. Hmm? While solving it, you have to be taking note of the transactions. Are you okay? Especially the ones that are pre-production, like this one, topography and geological physical studies. You know that this one is a pre-production. Get yourself familiarized with some of the transactions. Are you okay? So this one too. So at the end of the first year, the total asset for the first year is what? So at the end of the first year, you are capitalizing 20 million, or is it 2 million? At the end of the first year, you are capitalizing 2 million. Then when you go to the second year too, we begin again. Okay? So exploratory drill and sample. Exploratory. Once it's exploratory, it is what? You capitalize. Construction of building, you capitalize. This one, purchase of land. You do not capitalize purchase of land. Who can tell me why we do not capitalize purchase of land? This one, you have to ignore this. You have to cancel out this. You don't include this one. Purchase of land. Why? Because land is not a depreciable asset. Land is not a depreciable asset. You do not include it. Okay. Permanent excavation. Permanent excavation. Yes. So you capitalize that one. When you are excavating, constructing of roads and tunnels, that is done at the development phase. Development phase, no, they construct road to the location, tunnels to the location, purchase of drilling machines, purchase of office equipment, legal fees. Are you okay? Legal fees for acquisition of lease. Okay, I mean going for the right. Removal of overburden waste. Purchase of what? Purchase of software. You understand it? Now this one, protocol to chiefs. Another protocol to chiefs is what? 5,000. Another protocol to chiefs is what? 5,000. Please, 5,000. This is disallowed. This is disallowed. Are you okay? Why? Because it shouldn't be something you should be doing. Only the first year is allowed. Apart from the first year, any other year is disallowed. Protocol to chiefs. You cannot be going to. This one is a bribe. When you go there for the first time, that one year, you have to go and greet them for them to welcome you. After the first year, you do not check any expenditure as protocol to chiefs again. It's only done once. And in the first year, are you okay? So this one is disallowed. This one will be disallowed. Can you see that? Now, topography, you capitalize. Geological, you capitalize. Trenching and stamp as sampling. So at the end of the second year, you capitalize everything with the exception of these two. Why these two? Because land we don't capitalize, and a protocol to chiefs too is a disallowed expenditure. So you add all this, and the second year to your total assets is what? 3 million. So I've gotten total assets of what? 5 million. Then let's go to the last one. The last one is 2019. So that one you go through it. This one, conducting market and finance studies. Conducting market and finance studies, no, it happens before production, so you capitalize. Can you see that? Thinking shaft and underground drill, it happens before production, so you capitalize. So you capitalize everything except the one that you don't have to capitalize. Permanent excavation, construction of roads, purchase of drilling machines, purchase of equipment, overburden striping, removal of overburden and waste rock. Next one is what? A sale for cash of survey software. Sale for cash of survey software. They got cash from selling a software that they have bought. What do? You less it from the pool. Sale for cash because before pre-production, okay, during the pre-production stage, you less any expenditure. So I'll less the 130 million. I've less it. Sale for survey, I've less it. 130,000, I've less it. Can you see that? Because this is a revenue. If expenses I'm adding, then revenue have to less. Are you okay? So you less this one from the pool. I've less it. Can you see that? So this one, you're preparing capital allowance schedule. Trenching sampling. Trenching. So this one is penalty. You see, this one is penalty. Less it. If I don't even bring it, don't less it. Don't bring it because here we are preparing capital allowance schedule. There is no statement of financial performance that will say you have to add back. I mean, you don't include it because this is capital allowance schedule. You're paying capital allowance schedule, so you don't bring something that is not supposed to be there. Are you okay? It's not a matter of you adding back that be. So you don't bring the what? The penalty. Don't bring it. So this one you don't bring it. The same way you didn't bring the protocol to chiefs for the third time. Okay, you don't bring it. This one you don't bring it. Now this one trenching and sampling expenses. So this one is an allowable expense. So add it to the capital allowance schedule. Sale of drilling machine. Sale. We sold the drilling machine. So this one we less it. It's an income. So we less it. Can you see that? Sale of drilling machine, less it. We have revenue from pre-production item of good. Less it. Any revenue beer you receive before production, you have to less it from the pool. Any revenue beer. So revenue from pre-production item of good. So less it from the pool. Are you okay? So at the end of the day, this one we get 4 million. When you add all the three, you get 9 million. So pre-production expenses, add all the three, you get 9 million. Are you okay? So I come to calculate capital allowance on this. Do you get it? So 9 million. But in 2020, remember that the year that we're preparing the financial statements is 2020. Are you okay? So in 2020, they said that what? Let's quickly do the 2020. So let's see. So say the following transaction took place from January 1st, 2020 to 31st December. Requirement, compute capital allowance claimable. So I've done capital allowance claimable in 2020. So capital allowance claimable in 2020 So capital allowance schedule for 2020. So requirement A, I'm doing the requirement again. Okay. So we have pre-production. Remember, this is the time we will take our first this is the time that we are going to take our first, how do you call it? Capital allowance, because we are now started production. Okay, this is 2020. This is our first capital allowance. So pre-production, then you have production. Okay, the assets we got at the production stage. See, this one, people usually call it class 1, and they call this one class 2. But it's all 20%, 20%. Are you okay? Pre-production. All expenditure you incur, you write them here. Are you okay? Good. So we have cost. So pre-production. From the table, we have this plus this, all making 9 million, right? So total pre-production class cost is 9 million. Are you okay? The production we are yet to do. Let's go into 2020 and see if they bought any assets. If they bought any assets, we'll add it. But let me write total here. If they bought any assets, we'll add it. If they bought any assets, we will add it. Are you okay? We'll add it to the production. The asset bought at the production. All assets incurred at the production stage. We put them here. At the production stage, after production. Are you okay? Any asset incurred, no, but this is pre-production. So this one is the total assets. If you didn't incur any, if you didn't buy any asset during the production stage, we just find 20% of this and to be the capital allowance. If you bought an asset during the production stage, you add it to this. Then the total, we find 20% on the total. That will be the capital allowance for that particular year. Are you okay? Good. So I'm doing the A and B. Now that I just showed you this so that you understand how the capital allowance is gotten. All what I did is to add all assets, expenses, any expenditure incurred during the pre-production stage. I added everything to get my total pre-production expenses. Are you okay? Good. So let's go. Let's go. The first one, you see, the following transaction took place from 1st January 2020 to 31st December 2020. Let's go. The company received compensation of 3,500,000 from their insurance for destruction of some gold mine. So B. Compute the chargeable income for the company. And next one, comment on the treatment of royalty payments. Comment on the treatment of royalty payments and acquisition of new mineral rights. Okay, so B. So B, I will say computation of chargeable income. 19th. So if you want to do this, what is the name of the company? Kanewu. Kanewu. Kanewu what? Kanewu Mine Resource Limited. Petroleum Mine Resource Limited. So when you finish this, you'll do what? You write chargeable income for the year 2020. Okay, so we have the first one saying that the company received compensation of 3,500,000 from their insurance. So this is another other income, right? So revenue from compensation is other income. I want the main revenue. Now, mining and processing cost included in wages and salary incurred during the year was this. Okay. Sales of gold and diamond is 3 million. So this is sales of gold. So this is revenue. So revenue. Sales from gold and diamond. Are you okay? This one, we are preparing a financial statement from scratch. We are not adjusting an existing financial statement. Okay, good, I'm done. Now, remember you saw other income. Add other income. Bracket compensation. Okay. The mining, okay, I'm done with this. I'm done with this. Mining and processing cost included wages and salary incurred during the year. So mining and processing cost. My total income. This is the total income. I could have just continued straight, but please, if I write the total, I'll get some tick. So let me write the total first. So now let's go. Mining and processing cost. So mining and processing. Mining and processing cost 120,000. 345,000. Because it is an expense. I've less it. Can you see that? I'm done. If they say stop work, I'll get six. Let's go. Ground rent paid to the administrator of stool lands. Ground rent paid to the administrator of stool lands. Ground rent paid to the administrator of stool lands. I'm done. If they say stop work, I'll get some maths. Next one, the company undertook further research and development. Please do not include research and development. I told you, it's a principle. Research and development is disallowed, and we do not capitalize it. It disallowed from the books because GRC is that you want to be smart. You want to be smart. You have already enjoyed recognizance cost as a capital allowance issue item, recognizance and prospecting as a capital allowance item, and you want to turn around come and take research and development. So do not allow you. So I'm done with this. By not writing it, I'm done. Royalty amounting to 11,355,92. Okay, this is the royalty was paid to the government. Are you okay? Royalty amounting to 11,355,987. So royalty. Please, what the right royalty are supposed to pay? Let's see. It's supposed to be the right royalty is supposed to be 5% times. I'll say something about this. 5% times the total revenue gotten from gold and diamond, right? So 5% times 378. 532,900. This is supposed to be the total royalty. Let's compare it and see if it's the same thing. They said royalty they paid is 11,000 or 11 million. Let's see if 5% of the total revenue. So 0.05 times 378. 533. Answer. You are getting 1,892,645. They got 11. We got 18. Meaning the royalty they paid is less. They paid less royalty, less than 5%. They paid royalty without referencing the total revenue. So you and I, we are going to charge the right royalty. So look at the requirements. They said, comment on the tax treatment of royalty. Tax treatment of royalty payment. So please, Royalty is an expense. You deduct it as an expense. Are you okay? So this is correct. This is what they charge. But do you know something? You can as well deduct the royalty of this. But then I prefer you do the right thing. It's supposed to be 5% of this total royalty mine. Total minerals improvement, 5%. And not this. Are you okay? Look, do the right thing. Let's do the right thing. Royalty should be 5%. Good. Next one. The company acquired new mining rights. Please learn something we call separate mineral operation or separate petroleum operation. Learn it, pan. Learn it, pan. Please learn the petroleum separate mineral operation and separate. Learn it, pan. Ring fencing, separate petroleum operation for petroleum and separate mineral operation for minerals. Ring fencing. Learn it, pan. Learn everything about it. When it's then they're using a shared processing facility, when learn it, hey, learn it, learn that topic. Hey, yeah. Okay, good. Let's continue. The company acquired a new mineral rights at a cost of 5 million. Are you okay? Bonus payments made in see new mineral rights. New mineral rights. The company acquired a new mineral rights. If it is a new mineral rights, then please, why come to deduct it from this one? A new mineral rights, no, you should go and treat it in a different. If you have to create a new company, you have to have a new expenses. New mineral rights expenses relating to a new company cannot be deducted from this particular one. Because Kanewu 2 is a different company. Are you okay? For the purpose of taxes, you have to segregate revenue and expenses for each company. You don't have to combine them. So therefore, new mineral right is relating to a different company. Therefore, anything around it will not include in this particular company. So they said the company acquired a new mineral right, 5 million. Bonus payment was made in respect of this, which is 3 million, and the legal and other professional fees was what? 121,800. It is not be allowed. This will not be an allowable expenditure because this is a new company and therefore it's supposed to be treated in the books of the new company and not this one. So therefore, I'm not going to treat it in this books. Done like that. Please bring fence no. This is not the first time I've seen something like that. There was this question we were solving too that we realized that the company incurred a cost that relates to some company B. You didn't include it. You remember? So please take note of that. Next one. Stoop preparation and development cost page was this. 884,300. The total cost of the stoop preparation and development incurred was one. They said this was occurred from 1st January to 20 December. Okay? This was occurred from January to December. Once they have told you that this occurred in January to December, then you have to treat it as an expense because it's not capital, right? So stoop preparation. Stoop preparation and development of the stoop. Cost how much? What paid was 884,300. The total cost of the stoop preparation and development incurred was this. So this is the cost they paid. But the total cost, including everything, was this. These two, which one do you deduct? Is it the cost incurred, or is it the cost they paid, or the total cost? Ladies and gentlemen, you deduct the total cost. What I say? The cost they paid. Sometimes you be paying some small things in addition to it. Are you okay? That you have receipts for. You get it? So sometimes you be paying some small things. Do you get it? So for instance, if you are going to buy a house and they tell you that, oh, the house you are buying is costing 200 cedis. Are you okay? Remember, the 200 cedis, even though you pay 200 cedis for the house, the 200 cedis is not the cost of the house. The actual cost of the house is the 200 cedis plus all registration fees, the commission you paid, any cost incurred to get the asset to its rightful position, or any cost incurred to make the assets ready. Any cost you incur to make the asset ready, no. That is the actual cost of the assets. Are you okay? So this one, they said the cost paid is 884,300, but the total cost, the intentionally bought the rate, total cost was 1 million. So we did that this one as an expense rather. Are you okay? The total cost is what you use. You don't use this. You use the total cost. Perfect. Proceed. Next one. IX. It says the total cost of business operating permits was this and this amount includes 400 provision. So here, this one too was incurred from January to December 2020. It was incurred within, okay? It was incurred between this period. So therefore, they said business operating permits. After we have started commercial production, we incurred business operating permits. Business operating permits, how much? 556. This amount includes 400,000 provision. So we less provision. So 5,563 200 minus 400,000. So 5,563 200 minus 400,000. Okay, you have 5,163 200. Are you okay? So it includes provision. Let the provision. Okay. Provision is based on estimates. Okay, continue. The next one. That general and administrative expenses totaled 190,000. Okay, general and administrative expenses. So general and admin expenses incurred totaled 190,467 100. This includes construction of huge iron gates. Which is 421,600. So you know huge iron gate is an asset. So that one you have to capitalize it. It's a physical asset. So this amount 190,467 100 minus 421,600. This amount, the huge iron gate, you have to capitalize it. You have to add it to your capital allowance schedule and compute capital allowance on it. 12 was true. 421,600. 194,667 100. Okay, answer. Get this. Yeah, the amount is huge. Okay. The amount is huge, man. So this one is an expensive asset. This 421,600, no, this asset 421,600. Let me add it to this 421,600. Okay. Good. Let's continue. This is an asset we have bought during production stage. Can you see that? I've added it. Continue. Selling and distribution cost. Selling and distribution. Selling and distribution much? 172,554 700. Finance charge. Finance charge including interest and loans. 211,500,000. Now last one, capital allowance. So that's all, eh? You less your capital allowance. Less your capital allowance. Okay, so total asset is 9,121,600. So capital allowance will be 20%. Okay, 20% of it, the total will be 9,421,600. Times divided by 5 or times 20%. In fact, let me make it times 20%. 20% is the same and divided by 5. Nine four two one 600 times 0.2 answer 18. The capital allowance is 18,84320. So capital allowance will be 18,84320. Are you okay? So come and let's say from this 18,84320. You get 200,000. 2 million. Go and do it yourself. Tax. Okay, they say chargeable income. So this will be a chargeable income. They say this will be a chargeable income. Maybe this is not correct. Go and do your own thing. This one, go and do your own thing. In fact, let me make it 8 million. Go and do your own thing. Good. So look at the question. It said, compute capital allowance. This is how you compute capital allowance. It's not difficult, man. Can you see that? Just add all your what? Your expenses, except the disallowed one, like penalty and paying bribe and all those things. Leave them out. Don't include land because you don't calculate capital allowance on land. When you add all of them, then you do what? Oh, here to see me. I didn't calculate it. Me, I don't like doing this one. Petroleum income. I left it like that. You see, I didn't find the answer for the students. Of course, that is me. You understand it? So you just add all of them, then that will be your total asset before production. Then during production too, you incur this one. That's the gate. Then in total, you get 9 for 20%. You are done. That's a capital allowance. Okay, this is another method of doing the capital allowance. That is method one, method two. Class one, class two. So this plus this, you get this. The class is not by force, total assets. So total asset times 20% capital allowance, the same thing. Can you see that? Different ways of clear cuts. The important thing is say, all asset that is. Then when you finish, you are done. Nothing difficult. Chargeable income. Okay, good. That's the final answer is not correct too. Now they said compute the chargeable income. We've done that. Now, okay, and tax payable and tax payable. See, chargeable income and tax payable. See, and the tax payable for 2020. So tax payable 35% times 800,000 or 8 million. I said the final answer is not correct too. 0.35 times 0.35 times 833. So you get okay, good. Now, there's a comment on the tax treatment of royalty. Please, royalty is that the tax implication is that you're supposed to multiply 5% on the total this one, and you charge it as an expense. This amount should be remitted to the government. You charge it as an expense. That's how you treat it. Acquisition of new mineral rights. When you are buying new mineral rights, we call it separate mining operation. Since this is mining, separate mining operation, okay? And hence, you are supposed to keep separate books of account for it. You don't have to include it in the same book, okay? You only keep the same book if you only keep the same book if what they are sharing a processing facility. Are you okay? That's when you keep the same books. But if they're not sharing, but in these questions, they are not sharing the same. So therefore, you keep a separate book of accounts. As when a question say that they are sharing the same processing facility, then they will keep the same book. Please go and learn it. That's just here. Business has to learn. That's all. Please, we are done with petroleum mining operation. I've done sharing of petroleum with you, and I've solved other questions, including these ones. You don't have any reason, the theory and this one, or blend it, learn everything. Are you okay? You don't have any reason to even score less than 15 or 15 under petroleum manipulation. Good. So please let me leave you to prepare to work. So I'll share this document with you, the one we did today, Alpha Limited, and I'll share the Carnival with you. Okay. The Carnival, the same thing is here. I just wanted to solve them with you. The same thing is here. Are you okay? The same thing. Rent, royalty, the same thing. Can you see that? The same thing is here. And I redid it with you so that you get a knowledgeable. You get it. The same thing. Are you okay? So I share these two documents with you. Okay. Understand them. Okay. Then write or here or the same thing. Okay. This is the one we did today. And this is the one from the recorded video. Right. Good. Please, in the course of doing it, did you come across something that was confusing you? If that was the case, I believe now you are sorted. You are settled now, right? Okay. Thank you all for joining today's class. We will meet God willing tomorrow so that we take some questions on business income. Are you okay? We'll solve some 3 questions on business income really tomorrow. Are you okay? Just to build our confidence. Sunday we have a mock. It is starting at 7 o'clock a.m. Sunday we have a mock. It's starting at 7 o'clock a.m. And it's a competitive mock. A very competitive mock. Are you okay? So please, if case you are not able to join and you go to church because of that, you're not able to join, no wahala. Make sure you go through the solution. But if you want to enjoy, you want to feel examination pressure, assume it was final exams, the pressure and everything, you can use this opportunity to test yourself. Are you okay? But in case you're not able to join, I will not take the solution later, but make sure you finish. In fact, make sure you go through the answer so that in case it comes, you can be able to do it. Thank you very much. If you have any question, you can ask. Other than that, this brings us to the end. If any question you can ask, either an business assessment. Those going to work too, you can go. I've basically finished. I'll not teach any new thing. Okay. But then if you have a question, you can ask. Either and that, business assessment. So somebody is asking from the chat box. Says Stephen, why is research and development cost not capitalized? It's not capitalized because, in fact, research and development don't capitalize it and don't expense it as well. Just disallow it. It's a disallowable expenditure because they are saying that there's something, if it is petroleum operation, we know there's something called explorations. We know there's something called development. Okay, it's the same as research. Exploration that you are researching, and the development you are developing. Are you okay? So you don't turn around and come and claim another research and development cost. They allowed you to capitalize it at the exploration stage. Are you okay? So you don't turn around and come and take it again. So we don't allow it. By business income, we allow it. In business income, we allow it. The same applies to the mining operation. Thank you very much. Let's go to work. Thank you very much. We'll meet God willing. Tomorrow dawn, we'll do questions on business income like we did today. Okay. We'll revise it quickly, do questions. All right. Thank you very much. We'll meet God willing tomorrow. Do enjoy the rest of the day. Bye bye. And make sure you learn. Learn. Bye bye.
Sir, please, tomorrow down there is a CR class. I don't know if we
Oh,
can.
don't worry. Don't worry. We'll just solve questions. So join the CR class. Are you okay? When you are less busy in the course of the day or the week, you can watch the recorded video. Okay. It's not anything giddy like that. Just solve questions like this so that we did. Anybody who didn't join could just watch the recorded video and be fine. Are you okay? Nothing giddy. Nothing giddy. Okay. Okay. Thank you very much. We'll meet God willing. Well done. Bye bye. Like this are dangerous. I just want to give you some small confidence. That's all.